Everyone, and welcome to Pensionmark's Q1 of 2017's Quarterly Market Series. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool in the webinar menu. At the end of the webinar, we'll take the time to go through these together. Third, there will be polling questions throughout today's webinar. All results are anonymous, and we appreciate your participation. Now, I'd like to introduce Pensionmark's Director of Investments, Ronnie Cox. As the head of the investment research team, Ronnie is responsible for managing the investment research and analytics for the Pensionmark network. Ronnie has been with Pensionmark for 6 years and has worked with participants, employers, plan advisors, and economists. He graduated at the University of California at Santa Barbara with a bachelor's degree in business economics and a minor in technology management. Ronnie holds Series 7 and 66 registrations and earned the Certified Fund Specialist and Chartered Retirement Plan Specialist designations. Thanks for presenting today, Ronnie. Now I'll turn it over to you.
Thank you, Renata, and thanks to everyone that joined the call today. As Renata said, my name is Ronnie Cox. I'm the head of the investment research group here at Pensionmark. And today, I just wanted to spend some time to look back at what happened in 2016, both in the financial markets as well as the overall economy. From there, I want to give a brief outlook on what we're seeing ahead, and then I wanted to open up to questions that you may have. So let's get started with the financial markets overview. And to kick it off, I wanted to take a poll from our listeners on what they believe the total return of the S&P 500 was in 2016. We'll open up the polling now, so click on your answer in the polling screen. Was it less than 0%? Was it between 0 and 5%? Between 5 and 10, 10 and 15, or greater than 15%? All right, looks like we've got several answers coming in, so we'll just give it a couple more seconds and then we'll close the poll. All right. So the looks as though the most selected answer was between 5 and 10%, with between 10 and 15% coming in second. As a matter of fact, the total return on the S&P 500 last year was 12%. The year actually didn't start off well for equities, but by the end of 2016, each of the major indexes, the S&P 500, the Dow, NASDAQ, and Russell 2000 posted year-over-year gains, reaching all-time highs during the year. The Dow recorded its best performance since 2013, gaining almost 13.5% from 2015. And if anyone keeps an eye on the markets, the Dow actually just closed over 20,000 yesterday. Stocks weathered severe financial crises in 2016, including China's economic slowdown and the Brexit vote. The Russell 2000 proved to be the year's biggest gainer, soaring almost 20% in 2016. Most of the gains in equities happened during the second half of the year as favorable corporate earnings, resurgent oil prices, and accelerating consumer income and spending sent positive signals to the market. Without a doubt, the presidential election proved to be a pivot point for the stock market as expectations of looser regulation, fiscal stimulus, and tax cuts fueled the market rally. Now into fixed income. Volatility best describes the long-term bond market for 2016. Yields on 10-year treasuries rose for the second straight year as prices fell. The yield on the benchmark 10-year treasury closed at 2.44%, up from its 2.26% yield at the close of 2015. During the early part of the year, bond prices rose as yields sunk below 1.4%. However, as investors saw a strengthening economy, higher inflation, and rising interest rates, a period of bond sales occurred, which peaked during the last quarter when the Treasury yield gained almost 0.85 percentage points, marking the largest quarterly yield gain since 1994. High-yield bonds were the best performing sector as oil prices rebounded throughout 2016. And lastly, to wrap up financial markets, I wanted to look at international equities. The big news on the international front was the United Kingdom's referendum vote at the end of June to exit the European Union, now referred to as Brexit. After the vote was announced, Prime Minister David Cameron, an opponent of the push to leave the EU, resigned, with Theresa May becoming the new Prime Minister. Equities took an immediate hit following the news of the vote, but recovered fairly quickly. The value of the pound remains near a 30-year low, and Britain lost its AAA credit rating, increasing the cost of government borrowing. Depending on negotiations, the UK is expected to leave the EU by the summer of 2019. In other parts of the world, China's economic growth slowed during the year, but later stabilized following further government stimulus. And central banks in Japan and Europe continued lowering interest rates to negative values, intending to motivate more lending and investing. Some other markets to note are Brazil and Russia, that saw strong gains in 2016, and Mexico, whose market struggled as trade rhetoric from both the Trump campaign and administration weighed on their markets. Next up is our look at the U.S. economy, which brings us to our second polling question for the day. How long do you believe we have been in the current economic expansion? Less than 2 years, between 2 and 4 years, 4 and 6 years, or greater than 6 years? All right, we got a lot of responses in, so we'll show them. So most, about half of everyone said greater than 6 years, which is correct. December 2016 actually marked the 90th month of our current economic expansion, making January the 91st. Now, while the current economic expansion has passed beyond 90 months, many people feel that the economy has barely recovered at all. Part of this can be seen by the slower and more gradual pace of this expansion compared to previous expansions, as shown by the light blue line in the chart on the right. Economic expansions have generally been getting longer as the service sector, which is a relatively more stable sector of the economy, makes up a higher percentage of GDP than the manufacturing sector. While the true nature of this slower, more gradual recovery is not yet known, some have attributed poor labor force and productivity growth, as well as overregulation that stifled investment spending. Looking at GDP, the economy maintained a roughly 2% average growth rate through the third quarter of 2016. Economic growth has maintained this pace since about 2009. The first quarter GDP rose 0.8%, followed by a 1.4% gain in the second quarter and a 3.5% increase in the third quarter. This increase in the third quarter was primarily driven by personal consumption expenditures, or the value of consumer purchases for goods and services, which increased an average about 3% through the first 3 quarters of 2016. Gross domestic income, which is a measure of all income earned from the production of goods and services, rose 4.8% in the third quarter of 2016 compared to a 2.5% increase in the third quarter of 2015. Now on to our next polling question for the day. What was the unemployment rate at the end of December? Less than 5%, between 5 and 7%, between 7 and 9, 9 and 11, or greater than 11%. All right, and we'll close the poll. So most of you got this right. The unemployment rate at the end of December, as reported by the Bureau of Labor Statistics, was 4.7%. Improvement in the U.S. job market was slow but steady, with employment growth averaging 180,000 new jobs per month in 2016, which is compared to an average increase of 229,000 new jobs per month in 2015. As stated, the unemployment rate ended the year at 4.7%, which is lower than the 5% rate at the close of 2015. According to the Bureau of Labor Statistics, there was about 7.5 million unemployed people in December 2016, which is down from the 7.9 million unemployed in December 2015. The employment participation rate remained flat, closing 2016 at 62.7% compared to 62.7% in 2015. And in 2016, the average work week was 34.3 hours, with the average hourly earnings from all non-farm payrolls in 2016 increasing 73 cents to $26, a 2.9% gain over 2015. And lastly, for the economic outlook, we look at the Consumer Price Index. The CPI rose 2.1% in 2016, a larger increase than the 0.8% rise in 2014 and the 0.7% rise in 2015. This also represented a larger increase than the 1.8% average annual increase we've seen over the last 10 years. While core inflation remained relatively flat throughout 2016, headline inflation slowly ticked up throughout the year. And for my final comments, I just wanted to provide an outlook for the coming months and year. But before we get to that, I wanted to throw in one last polling question for the day. This polling question does not have a right or wrong answer, but is more on how you feel about the outlook for the economy in 2016. Not confident, neutral, confident, or very confident. All right, and we'll close the poll. So with 86% of respondents saying either neutral, confident, or very confident, I think that's a positive sign. Looking ahead, we see a very transitory period ahead of us. Starting with Brexit and the Trump election, there appears to be a continuing transition from globalism towards populism, particularly in Europe. We're looking at the European elections this year, with Netherlands, France, and Germany all threatening to overtake the establishment with populist candidates. With the Netherlands elections in March, France's in April and May, and Germany's through October, it'll be interesting to keep an eye out on these elections throughout the year. With the new Trump administration, we also see a potential transition from a slow growth economy to a more pro-growth environment, particularly in regards to increased infrastructure spending, which is anticipated to increase inflation, as well as decreased regulation, which is anticipated to increase investment spending. With this increased spending, we're also likely to see a transition away from monetary policy, as the Fed is likely to raise interest rates 2 to 3 times this year, and a transition towards fiscal policy as the government drives more spending. While the pro-growth prospects for 2017 are a positive sign, it's not without risk. With increased political tensions and potential for the Trump administration to start a trade war with various countries, the levels of uncertainty appear to be increasing in 2017. With all that said, I'd like to end it with my comments on this slide. This slide represents the annual returns of various asset classes for the last 10 years, with a sample asset allocation denoted in the blue box with an orange star. While it's difficult for even the most experienced economists and market experts to predict how the markets will behave in the next 6 to 12 months, it's always important to keep in mind a long-term focus for your retirement plan. While the asset allocation displayed in the table has never been the top performing asset class in the last 10 years, it's never been the worst performing either. Keeping an appropriate asset allocation based on your particular circumstances is an important factor to keep in mind with your retirement plan. And with that said, that wraps up my prepared comments, so we can go ahead and open it up to questions. Renata?
Yeah, thank you, Ronnie. We appreciate you sharing your time and knowledge with everyone here today. As you mentioned, we'll now start addressing some of the questions that have been filtering in. And please remember that if you have any questions, you can always submit them using the Q&A tool on the webinar menu. As always, you can always reach out to your dedicated service team at Pensionmark as well for any plan-related questions. The first question today is, so is the presentation deck available? So yes, the presentation deck will be emailed out to everyone who received the invite, as well as the recording of this webinar. So you will be receiving that within 1 to 2 weeks. The next question here, how do you think the Trump administration will impact the market in the next 12 months? Ronnie?
That's a great question, and I think probably the question that's top of mind for most people. Like I said, in 2017, it appears that levels of uncertainty are increasing. There's a lot of statements that are being put out by the Trump administration in terms of what they would like to see in 2017. Some of the key components of that I would point out surround infrastructure spending, which can be a boost for the economy as we push more money to building roads and highways and bridges that can help spur economic growth. Another big tenet of what the Trump administration has been talking about is deregulation, particularly in financial services, in healthcare with the rollback of the Affordable Care Act, and in energy. So with decreased regulation, there's an anticipation that these businesses will produce a lot more investment spending, which is a spur for the economy as well. Again, with that all said, there is still potential with going back to the Trump administration. They've talked about potentially having tariffs on goods, 40% tax on certain imports coming in, particularly from Mexico and China. And with China being one of our biggest trading partners, that could spark a trade war, which would have negative effects, at least is the view of most economists, for the U.S. economy.
Great, thank you. We got a couple about the Trump administration. I think you covered those well. Next question, what fund best reflects the Russell?
So I'm going to assume that the questions for the Russell 2000, because it was mentioned in the presentation. There's a few various Russell indices, but the Russell 2000 is generally referenced small cap index, and there's several funds out there that replicate or manage to track the Russell 2000. I don't want to give any endorsement to any one particular fund, but I would say to reach out to the Pensionmark Financial Wellness Center to get more information on a fund that may track that index.
Thank you. We got a question here. What is asset allocation?
Excellent question. Asset allocation is the diversification of your money or your portfolio into various asset classes. So generally that's thought of as a mix between stocks and bonds. We like to break it down a little bit further in terms of large, mid, and small cap equities, domestic and international equities, and various asset classes in fixed income as well. So you've got your regular government fixed income bonds, you've got corporate bonds, and there's varying degrees. So if learning about asset allocation, learning about your own specific asset allocation, if that's something that you're curious about or want more information about, I would encourage you to again, call the Pensionmark Financial Wellness Center. We've got licensed representatives that can talk you through that.
Okay, so I think we have time for a couple more questions here. As a 401k participant, what does the market reaching 20,000 mean in regards to mutual funds? Does this allow me to be more aggressive with my funds?
That is an interesting question, and one thing I will that I want to emphasize is to keep in mind the long-term focus of a retirement plan. So while I think the Dow reaching 20,000 is great headline news, I don't know that that is necessarily a trigger for anyone to start making portfolio adjustments just because of that. I think it's important to keep in mind your particular circumstances, what your risk tolerance is, what your time horizon is, how long you have until retirement, and plan your asset allocation according to that. It's sometimes exciting to read the headlines about the market and make action on those headlines, but at the end of the day, I think it's important to keep in mind that you want to be diversified, you want to be balanced, and you want to make sure that your asset allocation accurately reflects what your risk tolerance and time horizon is.
Thank you. So next question, which sectors expect growth? How will bonds do?
That's a great question. I don't want to specifically point out any one sector because historically economists, I think, like to predict certain levels of return for certain sectors, and I feel like their batting average is 50-50 at best. So, but with that said, I think there's some sectors to keep an eye out, particularly with the Fed raising rates, as well as the Trump administration talking about their agenda moving forward, with deregulation proposed in financial services, in healthcare, as well as a couple other industries. Those will be interesting to keep an eye out for. With the Fed raising interest rates, that also has implications for various industries such as financial services. But again, I don't want to make a prediction on any one sector, because I want to make sure that people are keeping focus on the bigger picture of a long-term time horizon in their asset allocation.
We got another question a little bit related to the forecasting of specific investment, but the question is, it looks like real estate investment trusts have done very well over the last few years. Has it had its turn being a good investment and will it go down, or is it will it still be a good investment?
This is another question, I think, that I'm going to kind of kick the bucket a little bit and say that I think REITs have a place in a person's portfolio. I don't want to make predictions on whether that REITs are still a good or bad investment moving forward, but REITs are a potential diversifier in an overall asset allocation. So whether or not to include REITs or real estate in an overall portfolio, and how much of that to include in your overall portfolio, I think is a discussion to be had with your financial advisor, or if you want some more education around that asset allocation, you can always call the Pensionmark Financial Wellness Center.
Thank you. We got a couple questions here that are plan related. We will get your contact information from the webinar and reach out to you specifically with that answer. But that will conclude today's webinar session. Thank you again, Ronnie, and thank you attendees for all your participation. Hope everyone has a great day, and we look forward to our next webinar series with you. Take care.